Coming up on Market to Market, renewable energy powers across a major threshold. And a group of Southern growers say out with tobacco and in with organics. Those stories and market analysis with Naomi Blohm next.
Funding for Market to Market is provided by Renewable Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Renewable Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, October 28 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The Bulls and the Bears from Chicago's LaSalle Street have been overshadowed this fall by the Cubs. The Northsiders helped drive demand for World Series tickets and merchandise. The economic lineup had some hits and misses this week as more Americans were buying new homes in September. Low interest rates, along with recent hiring, helped boost the market by 3.1%. However, orders for big-ticket manufactured items slipped. The 0.1% drop was attributed to a stronger dollar. Overall, the U.S. economy grew at a 2.9% rate in the third quarter, the strongest pace in 2 years. And one of the world's largest oil companies reported slumping profits. ExxonMobil revealed third-quarter income at $2.65 billion, a drop of 38%, mostly on low prices for crude. Demand for oil has dropped and can be attributed to many things, including the rise of alternatives. David Miller reports on a threshold hit this week.
The shift away from fossil fuels has hit an important landmark and now represents a majority of the installed global electrical generating capacity. A report released this week by the International Energy Agency, or IEA, suggests the global move towards renewables is happening faster than expected. Capacity is the key to the energy equation. According to IEA data, due to the variability of renewable power sources like sunshine and wind, energy produced by coal-fired facilities can exceed production from renewables by up to 40%. Coal plants operate at an average of 60% of their production capacity, while wind plants pump out only 35% of their potential, and solar panels provide only 20% of their rated output. However, the construction of renewable power sources are scaling up rapidly, and the main reason is cost. IEA statistics show solar and wind generation is consistently cheaper per kilowatt hour than coal or natural gas. Uncertainty surrounding the potential for carbon taxes charged on the consumption of fossil fuels also is pushing utilities towards renewables, despite their production drawbacks. And the installation of more clean capacity faces an uncertain political future. Several other renewable energy sources lost valuable tax credit privileges during the previous congressional season. In exchange for lifting the ban on exporting American crude oil, an extension of tax credits was approved, but only for solar and wind projects. Tax credits for other renewable sources, such as hydropower, geothermal, and biomass, will run out at the end of the year unless renewed by Congress when it returns from the November elections. For Market to Market, I'm David Miller.
People need different motivations to change. Some require sticks, and others prefer carrots. In an effort to encourage tobacco farmers to move away from that crop, the government stepped in to provide incentives to that group of growers. What started as a way to recover from the Great Depression of the 1930s eventually led to a new take on the standard co-op. Peter Tubbs has our cover story.
These pallets of organic produce at Eastern Carolina Organics are destined for the 5 Whole Foods stores in the Raleigh-Durham Triangle. The organic strawberries, kale, and greens were grown on land that once supported tobacco, but is now transitioning to organic produce as a result of the 2004 Tobacco Transition Payment Program. But TTPP dollars did more than change the economics of individual farmers. Grants from the program helped assemble the infrastructure needed to assist farmers in increasing their reach into new markets.
They do all their marketing for us, and so it gives me more time to work on, what I like to do, which is farming.
Most of the produce from his 300-acre farm goes to Eastern Carolina Organics. The farmer-owned co-op began as a wholesale food aggregator, coordinating with farmers to grow the produce the market needs, then delivering the produce to retailers and box delivery companies. Farmers receive 78 cents on each wholesale dollar, with ECO covering its expenses with the remaining 22-cent margin. Matching farm production with consumer needs requires coordination with distributors like ECO.
They have a production planner that works with us every January, and they try to figure out what we want to grow and what they need, and we just try to work it out to what's best for both of us.
The coordinated production plan means the producer grows, harvests, and packs produce, then delivers it to the ECO warehouse in Raleigh. ECO staff then inspects, sorts, and repacks the produce for delivery to other wholesalers and retailers in the region.
One of the greatest pleasures of my job is being able to sign checks every week to farmers, and especially being able to tell elected officials and other economic development representatives that we've paid over $20 million to North Carolina organic farmers in the history of our company.
ECO began as an experiment to learn if the Raleigh-Durham market was ready to support locally grown organic produce. Access to a market conduit encouraged farmers to risk the organic transition period in order to convert conventional ground. The results have been positive, both economically and environmentally.
We're actually ending up at the end of the day making more money growing products organically. I think it's simply because the consumer wants the higher quality product and they're willing to pay a little more money for it.
Consumer appetite for organic produce has resulted in growth for both ECO and other organic vendors in the state. In 1999, North Carolina had 27 retail grocery stores with substantial organic inventories. Today, the state claims over 500 such outlets. Even with 1,700% growth in availability, only around 1% of state vegetable consumption is organic. This growth has allowed ECO to move into a larger warehouse space with 2 different cold rooms to maintain the produce cold chain from field to store. Some produce crops, like kale and strawberries, are temperature and humidity sensitive and must be iced down in the field to protect them on the journey to Raleigh. Once unloaded, they are moved into 38-degree storage as quickly as possible, and they remain in the cold as they are sorted and packed for delivery. Feedback from retailers assisted ECO during its startup phase, down to details like how to pick and package broccoli. The learning curve is never ending.
What's very special for us is that the communication works both ways, and when we hear from our farmers that there's extreme challenges with growing any certain crop or maybe in accessing the seed, we're out there trying to figure out how to help them.
Organic production has built-in market advantages. The 3-year switchover period is a barrier to entry for conventional farmers. As a result, the smaller number of players in the organic market experience fewer price swings. Owen Rouse has transitioned his farm twice in the last 15 years, first from tobacco, corn, and beans to conventional produce. Recently, he has been switching to organic production, and the benefits have been more than economic.
I think the soil's a lot healthier, for one thing. It's not getting a lot of herbicides sprayed on it to actually deaden the land. I think we have a lot better quality, healthier soil now than we used to have. We use a lot of cover crops also in times when we don't have actual marketable crops on the field to help build up the land.
Using hoop barns, North Carolina farmers can grow produce crops year-round, which keeps employees busy year-round, reducing turnover. Replacing chemical input costs with higher labor spending helps the local economy as workers spend their incomes in the community. For Cottle and Rouse, the downside of producing organically is that the organic customer is growing more sophisticated.
10 years ago when I first started growing crops organically, The quality didn't have to be as quite as good as it does now, and it's mainly because you got more competition from other farmers, and also you got the consumer that they've seen it pretty, so they expect the next time for it to look that way.
But we produce, I would say, a much better quality product now organically than what we used to produce conventionally.
With consumers willing to pay a 15 to 60% premium for organic produce, organic production can be economically viable on a much smaller scale than conventional commodity crops. Many of the 40 growers who supply ECO are working 100 acres or less, making farming a viable option for those just starting out. The move away from commodity crops is one reason the average age of North Carolina's farmers has dropped from 53 to 48 in the last decade, while most of the country watches its farmers grow older. Chronic believes the switch from tobacco quotas to produce farming has done more than just put cash into farmers' pockets.
But we really wanted to make sure we were reversing the conversation that our farmers were having with their children. And partially that's how do we restore farming as a really dignified career so that people feel like it has some good security for them. It's not just financial security, but it's the kind of thing they want to tell their next generation. Son, daughter, if you work really hard and you do well in school, you too can grow up to become a farmer.
For Market to Market, I'm Peter Tubbs.
Next, the Market to Market Report.
U.S. wheat struggled to compete globally, while homegrown corn remained the cheapest in the world for buyers as harvest went past the halfway point. For the week, December wheat declined 6 cents, and the nearby corn contract added 3 cents. Demand for soybean oil pushed the soy complex higher earlier this week, driving the November contract up 19 cents. Demand for December meal also moved the market, adding $11 per ton. In the softs, December cotton reversed the trend again this week to move $1.75 per hundredweight higher. Over in the dairy parlor, November Class 3 milk futures were a winner again this week, rising 21 cents. Another positive week in the livestock sector as the December cattle contract improved $2.47, November feeders rose $1.85, and the December lean hog contract broke an 8-week losing streak by adding nearly $5. In the currency markets, the U.S. dollar index fell 34 basis points. Crude oil went back below the $50 mark, losing $2.15 per barrel. Gold went up $9.10 per ounce, and the Goldman Sachs Commodity Index decreased 6 points to finish the week at 370.10. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Thank you.
I want to dive right into this wheat market. We pushed up over $4, looked like we were on a roll, and we've pulled back this week. Export demand or a stronger dollar? Combination? What happened?
Everyone, I think, got a little excited with some commentary about exports being pretty decent so far to start the week, which we haven't seen in a while. But then Russia came in and had their best 4 months ever, so it kind of stole some of our thunder. And we just didn't have the immediate friendly news to sustain the rally. So we're back into consolidation phase for the wheat market. Probably see that December market maybe touch the $4 area, but the longer term setup starting to turn a little friendlier yet. We see the funds covering some of their short positions slowly because they're watching the weather in Australia and they're watching the weather in the United States and of course in Argentina where it's been a little bit wet. So we need just a few more hints of not perfect production and export demand picking up pace, and I think we're going to finally see a bottom to this wheat market. We're just waiting for that news to make the rally happen.
Okay. Now, we've talked for quite a while, on and off again for the balance of this past 6 months, about La Nina. Should La Nina come into effect, what impact would that have in Australia?
Well, it's for Australia, I believe it's going to get them a little bit drier, and I'm not quite totally for certain on that, but I know that for South America, it'll really make it hot and dry, and for the United States, for the plains, it's going to make it hot and dry. And already we have Texas and Kansas that are 30% abnormally dry according to the most recent Drought Monitor Index. So if that trend continues throughout winter, well, then we have another small, case for the wheat market to, again, find a reason to move a little higher here.
Maybe chew through some of these 1.1 billion bushels of wheat stocks we have. Do you anticipate any further shocks coming out of USDA from this wheat market as we look out into the future?
No, not on wheat. No, I think it's almost like they're ignoring that whole complex in a sense. So not any surprises for wheat.
All right. Corn market, little higher this week. We're holding above 350. How excited, Naomi, does that make you about this corn market?
Well, we could obviously say that the low is in place for sure.
Okay.
In the coming weeks, though, in hindsight, we could say that part of this was the October rally, which was, of course, helped fueled by short covering and ideas that the crop yield would potentially be getting smaller. But now some are saying, well, maybe the USDA won't quite lower the yields any further on the next report, just because with the most recent pace of what we're hearing for yields, nothing is coming in as alarming. We're hearing a lot of not as good as last year, but it doesn't stink. And so when we don't hear farmers complaining, it's all right out there. But we do look for the market to trade sideways here because it's really trying to get set up for more demand scenarios, and the ethanol numbers are really looking amazing. And then, of course, the funds, they went from being short over 150,000 contracts, and now with this week, they're estimated to be closer to net short only like 50 or 60,000 contracts. So they are starting to focus more on the fact that the emerging markets and the emerging economies are going to be maybe doing better, and so they're hoping that they're going to be buying more commodities in general. One more little thing on corn is actually that in China, this week they announced that they're going to subsidize some of the major processors $29.50 a ton for, it's ridiculous. It is ridiculous.
For producing using their own corn?
Using up that nasty corn.
Okay.
So that's what they're trying to do. So now they got to pay them to actually use it up because it is so disgusting and miserable.
How effective is this going to be at 29 bucks a ton? You're a lot more in tune with the ethanol industry and some of these other processors. Does it make sense to use 5-year-old corn that's been stored outside, even at 29 bucks a ton premium?
Here's my best guess. I think they're going to do what they can do just to keep the headlines such that global ending supplies are humongous. But at the end of the day, they're going to be slowly buying the DDGs when no one's looking and trying to not make a big headline about it. So that's exactly what we're watching. The DDGs, we're watching the sorghum, we're watching corn exports, imports from not only the United States, but are they buying from anywhere else around the world because they're sneaky. Okay. So they got to watch what their backdoor plan is going to be.
Now, for farmers who are getting these yields that aren't terrible, maybe we're filling up our bins, thinking of making some sales, cash flow needs to finish out the quarter. Are you pulling the trigger here with futures above 350? Do you anticipate the cash market tightening here at all in the future?
Making sales for those who need to make sales for whatever reason, but we have been looking at re-owning it with bull call spreads out to next December. $4 to $4.50 bull call spreads. Traditionally not one of my most favorite tools in the toolbox, but this year it might be the right tool because the cost is appropriate, 13 to 14 cents. You've got that time for a whole year. And if the market continues to, just kind of lump along sideways, maybe we can buy that sold call back cheaper and then have the long call free and clear, keeping an eye on the La Nina patterns. But most producers, if they can store, absolutely store. The basis should improve because everybody's going to store. So at some point, the elevators have to bid up to get that grain out.
All right. Soybean market, the sweetheart of the week from a producer's perspective, north of $10. It's a very exciting week all the way around, Naomi. Got a question here from Neil in central Wisconsin. We'll go right to this. Neil wants to know, is looking at the current futures, should I hedge now?
Yes. For what you're harvesting and even taking a look out to 2017 to get started. For what is being harvested now, this has been a wonderful rally because of the threat of La Nina for South America, which of course isn't going to show up for 3 or 4 months. But it's also been because the palm oil production was, lower, so the demand for soybean oil is so much stronger. And again, with those funds there. So this has been a nice short-term October rally. We look for the November market to start to trade sideways and then probably see them increase yield on the next USDA report. So yes, make sales here, but also just like corn, be willing to re-own it because if La Nina does show up, it is really going to have the ability to attract that big money into the market, and it can push it higher.
Now, you mentioned this is a nice short-term October rally. So if I'm making some cash sales here across the scales at the elevator, do you want me to hold off on re-ownership until this gets a correction back to the downside? Or do I run out and re-own today on November or January futures?
the recommendation that we had been looking at was to do a little something, because you just never know if the market's going to take off and go higher. But for the most of it, waiting for the setback, because we probably think it'll show up in November, because there's not going to be a lot to talk about, with the expectation that yield is going to be increased on the next USDA report.
And probably in the near term, whether it's a November or really a January, March, would you be looking at a call as the way to re-own it?
Yeah, and also there, again, the bull call spread, again, not my most favorite tool in the toolbox, but if you do the November $10 to $11 bull call spread, you can get it done for 30 to 35 cents. You can be more aggressive with it down the road. But right now, being aggressive and high-risk strategies aren't the thing to be doing.
Okay. This week, we also saw cotton had a move back to the upside, $1.75 higher. We're on a seesaw here, Naomi. How do you trade this market?
With cotton, I would take advantage of the higher prices that are there right now. There is some talk of actual production concerns in the Carolinas because of the hurricane, and a lot of that crop is still underwater, waiting for that water to recede. But the crop in Texas, really good, and the harvest is on target. Exports have been all right, but if you look at the big picture, China also not importing like they used to. For the month of September, their imports were up, but still not compared to anywhere that they've been in the years past. So again, looking for needing a production issue along the way, but take advantage of the prices that are there now.
All right. And Naomi, we love to have it when you were on market to market, because as a native Wisconsinite, you are our dairy expert. Tell us a little bit about where you see this dairy market headed. Traded here in the mid-15s. Can we break through $16 again by year's end?
I don't think so. Okay. I think we stay between 15 and 16. We just had a September production report released, and milk production was up 2%. That's a really big number. But the good thing is that on the global scale, we're competitive again as far as the cheese is priced and the butter is priced. On the global dairy trade auction, cheese is $1.50 a pound. I think we're about $1.54 on the mercantile exchange. Butter is at $1.80. So we're competitive again from that standpoint, but we still have so much supply. I did read that in Europe, they're going to do like a volunteer program, so the European farmers are going to be reducing production for the fourth quarter by 3%. And what it'll do for the overall year is keep production flat. So, there's little bits and pieces that are happening out there, but there's not any big story to tell right now, so looking for more of a sideways trading range.
Okay. And big stories to tell as we take a look in here at the live cattle market. We've got a comment from Matt in Amherst, Wisconsin. He's asking, will the beatings continue until morale improves in the cattle markets? Is the low in?
I think it is. I think that it's about as far as it's going to go for right now, yet we don't have a reason for it to really take off higher. The cattle on feed report last week was friendly to keep the market from falling apart any further. On my drive here, I've never seen so many cattle out grazing in the hills across Wisconsin and Iowa. I've never seen that many. So that's a really telling sign. And so production continues to increase, and any rallies we have should be selling opportunities.
Okay. How far out are you selling on these rallies? Are you selling just the nearbys, or do you want to sell as far out as possible?
Out to August is what I've done. I'm not comfortable going further than that, though, but we've been telling our people to do what they can with their processors and things like that to make those cash sales, and then doing some option strategies out to February. Not too much further than that because it gets too expensive, but out to February.
So low is in on the live cattle markets. Feeder cattle, Naomi, same question. Do you think the low is in?
I do, and that'll have a nice corrective bounce here. It has been. But again, not any reason for it to go racing higher either.
Okay, so we're looking at a lot of stagnation. Dairy, live cattle, feeder cattle. A market where we haven't seen stagnation this past week is the lean hogs. Naomi, up $5. What changed?
Great question. I don't really know for sure what changed. It was just that I think the short covering needed to finally happen. It's the end of the month. And there was, with the hurricane, some of that processing wasn't there. But overall, we still have a lot of hogs that are coming to market and coming to slaughter. But I think the low definitely is in place there. And so we'll see that market now try to find a place of equilibrium to really see where the production numbers are, where the demand is going to be. It's not going to be a tremendous rally by any means, but I think we can pick up our feet and our jaws off the floor because I think that the worst is behind us.
Okay, so this week's rally, $5 to the upside, is that enough to make you sell, or are we building excitement that maybe there's another $2, $3, $4 to the
Actually,
upside?
about 3 to 4, maybe 5, technically speaking.
Okay.
We just need a little bit more supportive news to make that happen, but the potential really is there.
In the mid-50s on the nearbys.
Yep.
Okay, so
Yeah.
it's something to keep an eye out
Yeah.
for. Now, the other story this week was the U.S. dollar. We continue to find strength, pulled back a little bit, but relative stability up here with the dollar index around 98. What's your take on the dollar as you look at the global scene?
Oh, we're stuck in the high upper 90s for a while. We have to wait, of course, and see how the election turns out and if the feds are actually going to raise interest rates or not in December. Every other day they go back and forth about their commentary on it. So and I don't look for anything major to happen before the end of the year. Just stuck up at this high upper 90s for a while.
Okay, floating around up in here. It'll be a headwind for the wheat market and livestock exports and dairy exports, but sunny skies will return.
Absolutely.
They always do, don't they?
We are in Iowa.
All right. Well, Naomi Blohm, thank you so much for taking the time to join us this week.
Thank you.
That wraps up the broadcast portion of Market to Market. But Naomi and I will keep the market conversation going, including answering more of your questions during Market Plus, and that's available on our website. Now, this week on the M2M podcast, we go back in time as one of our analysts talks about his start with the first host of this show, Chet Randolph. You'll find it wherever you get podcasts by searching M2M. And join us again next week as we look at what's holding up free trade with Cuba. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.